Dividend ETFs are a great way to diversify your portfolio and make consistent returns over the long term. The beauty of these investments is that you don't need to do any research or actively manage them. They generally pay out dividends on a regular basis, so all you have to do is sit back and watch your money grow. Here are 5 of the best dividend ETFs that can help get you rich in 2023. First off, what is an ETF? Before we get into the nitty-gritty of which dividend ETFs are the best for 2023, let's quickly go over what an ETF is. An exchange-traded fund, or ETF, is a type of investment that tracks an index, a commodity, or a basket of assets. In simple terms, you can think of it as a mutual fund that trades on an exchange. ETFs often have lower fees than traditional mutual funds, making them more attractive to cost-conscious investors. These days, dividend ETFs have become increasingly popular as they provide investors with a simple way to diversify their portfolios with high-yielding stocks. According to Morningstar, dividend ETFs have added nearly $20 billion to their collective assets in the past year alone. That is huge. But how does this whole dividend ETF thing work? Basically, the best dividend ETFs invest in a mix of high dividend stocks from various sectors. This allows investors to diversify their portfolios and benefit from both consistent cash flow and capital appreciation over time. The fund manager makes sure that the funds are well diversified and that all investments meet certain criteria. This makes it easy for investors to get the most bang for their buck without having to do any of the research or analysis themselves. Now that we've got that out of the way, let's look at 5 of the best dividend ETFs for 2023. Let's start with number 5, the Schwab US Dividend Equity ETF, or SCHD. This ETF seeks to track the total return of the Dow Jones US 100 Index, an index designed to measure the performance of high dividend yielding stocks within the US that have a history of consistent dividends. It had an impressive 10-year average annual return of 14.35%, meaning that a $10,000 investment 10 years ago would be worth close to $40,000 today. What's more, SCHD has arguably been one of the best investments over the last decade for investors seeking a combination of income and growth. It currently holds 102 dividend stocks with top holdings in familiar companies like Maranco, Pepsi, Coca-Cola and more. In addition to its impressive performance, SCHD has also provided a competitive dividend and managed to grow its share price enough to provide returns better than world-class ETFs like VTI. It's even provided far better returns as compared to other similar ETFs like VIG, VYM and DGRO. And with an expense ratio of around 0.06%, SCHD is one of the lowest cost ETFs on the list, meaning you'll only have to pay $6 a year on $10,000 invested. So not only are you getting a great investment return, but you're also getting a competitive dividend yield, with SCHD currently having a yield of 2.83%. That means that $10,000 invested can make you about $283 in dividend income per year. That's really impressive, and investors who are looking for a reliable way to make their dreams of financial freedom come true, they should definitely check out SCHD. Like SCHD, DVY also seeks to track the investment results of a specific index. In this case, it's the Dow Jones US Select Dividend Index, which aims to represent US leading stocks with high dividend yields. DVY has been around for over a decade, and it's done well over that period of time. Over the last 10 years, this ETF has returned an average of 12.41% per year, which means $10,000 invested 10 years ago would be worth close to around $30,700 today. It currently holds 99 stocks with top holdings in Altria, IBM, Philip Morris and others, and it's managed to grow its share price enough to provide returns better than world-class ETFs like SPY and VTI. What really puts this fund over the top is its dividend yield, which currently stands at 3.03%. That means with $10,000 invested, you can expect to make about $303 in passive income each year. And let's not forget about the expense ratio, which is 0.38%. That means that you'll only have to pay $38 per year on $10,000 invested, making DVY one of the lowest cost ETFs on our list. However, it's definitely worth noting that DVY doesn't provide the highest dividend yield on this list. Some of the later ETFs on this list will surely pay out almost triple in dividends, so keep watching to see what they will have in store. DVY is definitely a great option for investors looking for a reliable dividend ETF, and it's certainly worth considering if you're looking to build wealth or retire comfortably in 2023. At number 3 we have the SPHD, so let's dive in and see what it has to offer. SPHD is an ETF that tracks the performance of the S&P 500 Low Volatility High Dividend Index, which measures the performance of the 50 least volatile high dividend yielding stocks in the S&P 500. Unlike other funds like SCHD or DVY, SPHD focuses on just 50 stocks from the S&P 500 that pay the highest dividends. That means it's a much more focused approach to investing in dividend paying stocks, and investors who are looking for a low risk way to invest for income should definitely take a look at SPHD. In terms of performance, SPHD has done very well since its inception in 2012. It has returned an average of 11.34% per year since then, and currently has a dividend yield of 4.14%, which is one of the highest on this list. It's also worth noting that SPHD is the first dividend ETF on this list that pays a monthly dividend. So you get a paycheck every month just by owning it. And to top it all off, the expense ratio for this ETF is only 0.30%. So you'll only have to pay $30 a year on a $10,000 investment. All in all, SPHD is an amazing dividend ETF, and investors who like the idea of receiving a monthly dividend should definitely consider it for their portfolio. Let's move on and see what's next on the list. This one is a little different from the others because it tracks the Morningstar Dividend Yield Focus Index, which measures stocks with high dividend yields. HDV currently holds about 75 stocks, including top holdings such as ExxonMobil, Aviva, Johnson & Johnson and other very reputable companies. When it comes to performance, HDV has done quite well over the last 10 years. This ETF has returned an average of 10.32% per year, meaning that $10,000 invested 10 years ago would now be worth close to $30,000. And the cherry on top of that is its 0.08% expense ratio, making it one of the lower cost dividend ETFs on our list. Therefore, with $10,000 invested, you'll only have to pay $8 per year. That's why HDV is a great option for investors looking for high dividends with low costs, and it should definitely be on your list of ETFs to consider. The previous 4 ETFs on our list are all very different from each other in terms of what they offer and how they generate returns. Now, this number 1 pick is going to blow you away, so let's get right into it. Is an actively managed ETF that seeks to deliver monthly passive dividend income and stock market exposure with less volatility by employing investing and options strategies. It's a unique strategy developed by JP Morgan that utilizes research analysts to build a high quality US stock portfolio using only stocks with less volatile earnings and share prices. They then sell the index options against that portfolio and use the premiums to generate income. It's a unique strategy developed by JP Morgan that utilizes research analysts to build a high quality US stock portfolio using only stocks with less volatile earnings and share prices. Then they sell the index options against that portfolio and use the premiums to generate income. They also sell call options every week to adapt to any changing market conditions. So when volatility spikes, for example, this ETF has potential to provide higher income to help cushion against market fluctuation. Currently, JEPI holds 112 stocks with top holdings in Bristol Myers Squibb, Progressive and Hershey. What's even more amazing about this is that despite being relatively new, as it was founded in 2020, it still offers a very generous dividend yield of 7.95%. That means if you invest $10,000 into this fund, you can expect to earn roughly $843 in dividend payments in just 1 year. So not only can you get long-term capital appreciation, but the JEPI ETF also pays a high dividend yield. That's why the JEPI is definitely worth considering for your portfolio. Now, what should be your next move? Well, now that you've explored the top 5 dividend ETFs, it's time for you to decide which one best suits your investing goals and make an informed decision. At the end of the day, all 5 of these dividend ETFs have their own unique benefits and drawbacks. SPHD is great for investors looking to receive high yield with low costs. HDV gives you exposure to blue chip, high dividend stocks, and JEPI offers a higher income potential with less volatility. It really depends on what you're looking for in your portfolio and how much risk you're comfortable taking. However, if I had to choose a single ETF for income investors, it would be JEPI. The JP Morgan Equity Premium Income ETF is still relatively new, but has already proven itself with its high dividend yield and low volatility. Plus, its actively managed portfolio makes it stand out from the others on our list and offers investors the potential for even greater returns in the long run. Whatever you decide to invest in, always remember that it's important to do your research and weigh up the pros and cons of each option. With the right ETF in place, you can build a strong portfolio with long-term returns. Do you have any favourites that we might have missed? Let us know in the comments below. Happy investing!